All right, welcome back, Finom Group members, Finom Group's general YouTube audience. Welcome to Finom Group's State of the Market. It's been a couple of weeks. Last week we didn't have our typical Thursday recording because we had some schedule conflicts. So here we are back at it once again, and we've gone nowhere. Well, this week, we basically have moved 7 points on the S&P 500. So in terms of choppy sideways price action, well, that's what 7 points will serve to identify over 3 trading days. Everybody's kind of still waiting for that big CPI number on Friday. So it doesn't, nobody's positioning with any conviction. It is one of the most highly touted and anticipated economic data points of the year, Friday's release of the consumer price index. So yeah, we're just not going anywhere. And we're getting a little bit of de-risking here on Thursday afternoon, possibly some hesitancy, folks doing a little bit of hedging ahead of the CPI number. Kind of to be expected. We found natural resistance level in the S&P 500 after that 6% plus rally. We did some consolidation of that rally last week and into this week. So let's get right to it, right? This graphic here kind of says it all about this year. The Federal Reserve's most anticipated recession in history may be coming, right? It seems like everybody sees a recession. It would be the first. It really would. It would be the first one that was just so easy to identify that you could step out of the way and just kind of say, well, I'll wait for it to come. Tap your fingers, wait for it to come. But it just rarely, if ever, happens that way. In my history as an investor, as an analyst, as a strategist, you've never been able to predict the recession. The only folks that have been able to predict, recessions are liars. That's it, liars. All right, so people who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. I think that kind of sums up the pandemic. Calamitous drops do not scare them out of the game. And this is a quote from Peter Lynch. Indeed, you're going to take losses as an investor from time to time, as a trader probably more often than an investor because you're dealing with shorter time frames, which just serves to promote the idea that you should always position with a long-term mindset. But there's going to be losses anyway. The savvy investor, the people that succeed in this business, if you will, they're the ones that don't get scared from setbacks, from losses, from calamitous drops in the market. They're part of the landscape. They're not bugs of the market. They're features of the market. Therefore, they're features of investing. They come with the territory. All right, something I recently said, yours truly, for what it's worth. The market trap, right? You always hear about this bear trap, this bull trap. The market trap is laid when the fears of today evoke a belief of ever worsening circumstances. History has proven there's no such thing as ever worsening circumstances. Yet the future is analyzed primarily for the risk it holds, not the rewards it yields. We, as investors, we tend to get into this mindset where we're always worried about the risk, right? That's what this graphic was about. Last week, we talked about this. When we think to the future, we're generally only thinking about the risk in the future. In hindsight, we realize the missed opportunities, right? That's the past. We can see the missed opportunities in the past. But in real time today, looking out to the future, we tend to only think of things as risk through the lens of risk, not the rewards, because it's almost always rewards, especially, again, if you have a longer term time horizon and you can kind of wait out the calamitous periods. We've heard a lot about recessions, right? I mean, that's how we're kicking things off. We heard a lot about recessions. And you see it all the time in the financial media. They continue to characterize a recession as 2 consecutive quarters of negative or contracting GDP. There's no such There's no such definition of two contracting quarters or negative GDP equating to or being defined as a recession. That doesn't exist. It's just a popularized narrative because recessions tend to last several quarters. The NBER, which is the National Bureau of Economic, I forget what the R stands for, but you get it. The NBER's traditional definition of a recession is that it is a significant decline in economic activity that is spread across the economy and that lasts for more than a few months. By the way, we called, it was a 1-month recession, right? 2020 was a 1-month recession. Was that 2 consecutive quarters of negative GDP? Of course not, but it was called a recession. This chart right here, this is GDP going back to 2000. The time frame is 2000 to 2003. For those of you who know your economic history, you remember that 2001 was also labeled a recession by the NBER. Now look at what happened. The first quarter, negative GDP. Here's the zero line. Here's GDP, first quarter of 2001. But then Q2 was positive GDP, more than 2% GDP. Back down into contraction territory in the third quarter and back up in the fourth quarter. You did not have 2 consecutive quarters of negative GDP, although the economic activity did weaken to the extent that the NBER still labeled it a recession. So, we had a negative GDP quarter in Q1. Right now, we're running about a 1 to 2% GDP in the second quarter, depending on who you ask. But even so, while the media is promoting this idea that if we have 2 straight quarters of negative GDP, that doesn't necessarily mean the NBER will call it a recession. Remember, it's about jobs. It's about consumer spending. I mean, consumer spending is 3/4 of GDP. So we have to see weakness there. We have to see weakness in the labor market in order to, show itself with recessionary conditions, enough so that the NBER labels it a recession. It's just differentiating between the rhetoric and the reality. All right, so we've looked at this chart before, this table of the big 4 indicators, which touch on those more, relevant aspects that the NBER looks at in terms of determining whether we're in an expansion cycle or we're in a recession. So the big 4 indicators touch on employment, industrial production, real sales or retail sales, and real income. And as you can see, month after month after month, here's the new year, January, February, March, April, with all the data in, all we've seen is a continuation of strength. I mean, each month you see the numbers are going up, 14.73, 15.28, 15.61, 15.94. These numbers, they fill in as these key employment data. So the non-farm payroll data comes out, industrial production comes out, retail sales, when they come out on a monthly basis, each square gets filled in. And once again, from the month of April, all the squares got filled in positively. And in increasing amounts, 10.68, 10.39, 10.69 for real income. Retail sales just keeps going up. Does this look like a recession, folks? Look at the trend lines. If you don't like low numbers, look at the trend lines. They're all sloping higher. The other thing to think about when it comes to the big 4 indicators is, okay, so what would lead us? Is there a number? Is there a level that suggests that we are approaching, if not in recessionary territory when it comes to the big 4 indicators? And there is. Going all the way back to 1955, this chart here of the big 4 indicators, if it gets to about negative 0.93 collectively, you get a negative 0.93 number, more often than not, you found a recession very near term if you're not already in a recession. But look at where the trend line is right now. We're well above that, folks. Employment, consumer spending, i.e. retail sales, industrial production, they're all very strong. Bear market start versus recessions, like we talked about that in the past. This is looking at the Dow Jones Industrial Average. The bear market started 1948. Here's the recession start date, right? This was June, but the recession start date wasn't labeled until November. The Dow Jones, the change in the Dow Jones was about 11%. The months in between where the bear market started and the recession was called was about 5.5 months. The rally during this time period was 8.1%. So these are all the bear markets going back to 1948. And these are the months that it took between where the bear market started and the recession was called. And the big rallies, there was big rallies in here, folks. And then there was basically no rallies. The cycle composite index from Ned Davis Research, we've looked at this many times in the past, especially last year. And we're at this period. Remember, this is a midterm cycle, which is taken into consideration by the Ned Davis Research cycle composite index for 2022. And we're doing generally what we should be doing. I remember I said this before, it's a midterm election years. Midterms generally don't bottom. The S&P 500 generally doesn't bottom until like the August, September time period. Here it shows July, it's showing up, which is not too far away if it holds to course. Remember, when we look at this cycle composite index or seasonal data, you're mostly looking at the average year, the average. You know, when do we ever get the exact average when it comes to market performance, right? Okay, we found resistance, folks, right? Because we know where support was in the past. This is a chart of the S&P 500 going all the way back to last year. Actually, it goes back 2 years. But right here in the 4150 to 4160 zone, we'll call it, is where it was support in the past, right? This is 2021. You can see kind of went sideways here for a few months. Basically from March to late June, we went sideways. But that 4150 to 4160 level proved support. Eventually, we kept going higher. Well, we had this dip below that support level, and then we came right back up to it, and wouldn't you know it, we found resistance. So the market checked back, and it's still in that check back or consolidation mode. A break above that on a closing basis, especially a weekly basis, in my opinion, bodes well for the continuation of this rally, relief or otherwise. Call it what you will. It's a rally nonetheless. But that's what needs to happen technically. We need to break above this, close above that 4150 to 4160 level on a weekly basis. And I think you get some continuation, barring any exogenous headlines. I know we get a lot of folks, what if this turns out to be like 2000 to 2002, right? Where we had 3 consecutive years of a negative return, right? Post the dot-com bubble bursting. Well, this chart is really a good way to perceive that probability. Right now, it's extremely low. Why is it extremely low? Well, because at the top in these square shaded zones, these were bull markets, cyclical bull markets that led to secular bear markets. I mean, quite frankly, the only way you're going to get 3 years of negative returns in a row is if you're in some kind of secular bear market, right? Is that what we're going into? Well, no. And the reason why I say that is because each time we went into a secular bear market, the PPO or price momentum on a monthly basis went negative, like it did here, like it did here, right? And that led us to secular bear markets. Here's where we are right now, all the way up here. We're not even close to going negative. So despite all of this turmoil in the markets and the turmoil that happened in 2020, the PPO did not tilt into negative territory on a monthly basis. It hasn't, even with this now almost 6-month-long correction. So we can kind of check that box so far as this is one of the reasons that we should not be, fearful that this is going to be a new secular bear market, right? Secular bear markets, can last anywhere from 5-7 years. Secular bull markets can last anywhere from 12 to 20 years. We still believe that we're in a secular bull market. We just have a cyclical bear market going on presently. This is the Nasdaq 100, a chart of the Nasdaq 100. And just like you want to know where your former support and present resistance levels might come in, it's the same thing for the Nasdaq 100. We found right here support where we had support in the past, right at that 50% Fibonacci level. And keep in mind, this is the Nasdaq 100, not the Nasdaq composite, but this is the Fibonacci levels for the Nasdaq 100. And we found support right at that 50% Fibonacci retracement level. Now it's about getting above the 1320 to 1365 level here, which again came back here. We found support at that level, had a really substantial rally, tried to hold support again, failed, went to the next key support level, found success. Now we're in between. Right now, we need that extra catalyst to get us back above this support level from the past. Right now, it's resistance until we can get above it. So just like the S&P 500 needs to get above and close above 4150 to 4160, the Nasdaq 100 needs to get above 1320 to 1365. We looked at this a couple weeks ago as well. When less than 10% of Nasdaq 100 issues are above their 200-day moving average, because recall, we had looked at that in the Nasdaq composite, this particular breadth metric. Only 10% of Nasdaq 100 issues are above their 200-day moving average. Usually you got a washout in the market. You've had enough cleansing, unless of course you are going into a recession, but usually you're not. So with that, with this kind of poor breadth, the returns going forward are usually pretty strong. 1 month later, I don't like that, positivity rate. We like positivity rates, probability rates, 70% or above. And the average drawdown for 1 month is 6.4%. So that's a reasonable possibility, which would take us right back down to that 50% Fibonacci level, if that was to occur. And folks, we got a CPI number tomorrow. It's a doozy. Okay, with the VIX at let's call it 25, that insinuates about a 1.5% move on the S&P 500 intraday. But that print is so heavily anticipated, it would not surprise me if we moved 2.5% to 3% tomorrow. I don't know what direction. It really just depends on the headline. So just keep that in mind. Anyways, 2 months later, after this kind of weakness and breadth in the Nasdaq 100, we get into the 70% probability rate, very strong returns. 3 months later, 6 months later, 1 year later. Looks good. Says stay the course. Stay the course. We still don't see those economic recessionary conditions at this point. We have a lot of derating, de-risking, deleveraging of the markets. We have yields moving higher. We have pressure on the equity risk premium. We have a housing market that is overly sensitive to these higher rates, and we see that coming, under pressure, right? That is one of those key economic or industries of the economy that is interest rate sensitive that we have to pay attention to, because if we see, more weakness there, it can spill out to other areas of the economy. What I would say is we shouldn't overly weight the weakness pending, if not developing, in the housing industry, because we've never had consumers with the amount of savings that they do have today in past kind of housing boom bust cycles. So even though housing can come under pressure, it doesn't mean consumer spending is going to fall off a cliff. Yes, if we had strength in the housing industry, even exponential growth in the house, it serves as a catalyst because people buy houses, they buy crap to go in the houses. But we still think people can buy crap even without the houses being bought presently because of that excess savings. And we'll get into that in a little bit. All right, with the Nasdaq taking the biggest hit this year, Nasdaq Composite, Nasdaq 100. Think about the triple Q ETF for the Nasdaq 100, if you will. As of right now, we don't see those earnings rolling over. As I've been preaching, and I'll get back on my soapbox for a moment, bear with me, I do anticipate downward earnings revisions, whether it's the Nasdaq 100 earnings, because the orange line here is the EPS, and you can see it hasn't rolled over yet. Folks, we just got an earnings guidance. The earnings guidance was lowered by Microsoft, right? That's the second most heavily weighted instrument in the Nasdaq 100, the S&P 500. If you don't think that we're going to get downward earnings revisions between now and the next earnings season, you're not paying attention. So we just need to anticipate this at the very least. Not keep our rose-colored glasses. Well, we should never have rose-colored glasses on. We need to look at all these fundamental metrics for what they are, unbiased, very objective. This way, we have the right mentality going into earnings season. So if we do see weakness, hey, no harm, no foul. And we should have the cash on the sidelines to act, because any near-term weakness, in my opinion, is going to be found with future opportunity and reward for that opportunity. Hence, cash on the sidelines. If those earnings don't come in as expected, if the beat rates aren't as healthy as they were in the past, you're going to want to pounce, because now we're setting a lower bar as opposed to higher bar when it comes to future earnings expectations. And a lot of times it's about those expectations. Corporate insider, we've talked about this many times. This is the most recent, and I seem like I update it week after week after week when it comes to our state of the markets. But corporate insider buy to sell ratio is still heavily skewed. This is the highest level it's been since back in 2012 for the Nasdaq components. The insider buy sell ratio is at the highest it's been since 2012. And I'll ask the question again: if they're buying their own stocks within the Nasdaq 100, why aren't you? What is it that they know that you don't? While we've heard all of this, poor sentiment, not just from consumers, not just from investors, but also from CEOs, remember, it's not what they're saying, it's what they're doing. What is the consumer doing? Well, they're answering these surveys, with these very dour sentimental readings, but the consumer's still buying. Left, right, front, and center. Retail sales, record highs. We got more data on that this week by way of the Bank of America card tracking analysis. All right, so insider buys are very strong. 2 months later, we like these win rates. We also like these returns. Look at a year later, folks. Like, if you don't have a year to wait, I don't know what to tell you. You don't have 6 months, I don't know what to tell you. 98% win rate, positivity rate, 100%. Come on, be patient. Be patient. Go feed the ducks for a little while. U.S. non-profitable tech, right? I mean, it's come all the way back down, right? Now, these arrows weren't on the charts before I drew them in. Only this arrow was on the chart, right? I got this from Goldman Sachs. So again, this is U.S. non-profitable tech price to sales ratio. And as you can see, get down to this line here. What happens next? Well, it goes higher, goes higher. I mean, this time right here, yeah, it went that much lower, but you didn't have to wait long. Here was 2003 that it found the trough. And again, it went higher into 2000, we'll call it from 2003 to late 2005. So again, you only had this arrow before. That's like looking at things through a glass half empty lens. We want to take the big picture overview, and it says when you get down to these levels, basically you should be a buyer. Now, I wouldn't be buying non-profitable tech. I'd be buying those better companies. Just like this is showing, insiders are buying And this says we should be looking forward to an improved price to sales ratio, even on unprofitable tech. Bottom line is there are buyers that step in here. At these levels, buyers are stepping in. You just have to be patient. All right, we've talked about correlations in the past, and kind of one of our bottoming indicators, if you will. Here we got to 0.48 just a couple weeks ago, right? When stocks tend to move in unison, they're more highly correlated, and you tend to see that towards the tail end of corrections and, at the bottoming phase. But ultimate bottoms, you tend to have those correlations go toward 1. They don't have to get to 1. Here's 0.9, so up here would be 1. We recently got to almost a 50.50 correlation. But as of this past week, we've rolled over from there. And that kind of, you can probably guesstimate that would be the occurrence given how the VIX has dropped and how VVIX has dropped. We've talked about the VIX. Look at this is a chart of the VIX. We've dropped all the way from, let's call it 35 down to 20, just under 24 at the close yesterday, just under 24, which it seems to have liked very much since December of last year. It's been resistance, it's been support, come right back down to it. Now, if we find ourselves in this zone and approaching 20, more than likely good things are happening for the S&P 500. We'll probably need a good CPI reaction tomorrow to get us, going or heading toward that 20 level on the VIX. Because if we don't get a positive reaction, if we don't get a good number that investors can, think is a good number tomorrow on the CPI, then more than likely this 24 holds, and we're looking at higher prices for the VIX or higher levels in the VIX. We talked about VVIX also, right? We've gone the whole pandemic and post-pandemic period without VVIX having 2 consecutive closing below 100. I'm of the opinion a big reason for that is because with the abundance of retail traders that opened up Robinhood's accounts and they got their government stimulus checks back in 2020, a way to leverage, what if you only got $1,000 stimulus check, you opened up a Robinhood account or what have you, well, you don't have a lot to play with there unless you're trading options. And we knew that, a huge part of 2020 through 2021's rally found a heavy participation of call options. And I'm of the opinion that's one of the reasons why VVIX could not fall and stay below 100. First time in its history. First time that it stayed, after the recession. We're talking almost 2 years before VVIX had 2 consecutive closes below 100. It's never happened before in history. So something had to change in the participation to do that. But, recently we finally have had 2 consecutive closes below 100. And we even got below 90 this week. This chart from Tim Ord, according to Tim Ord, it's a good sign for a rally in the S&P 500 when both VVIX top window, right here, here's VVIX. As you can see, we finally broke 100 here, kept moving lower. When both VVIX and VIX trade to new short-term lows. And here's the VVIX to VIX ratio. When that turns up, again, usually good things are happening inside the S&P 500. And it has recently turned up, but we probably need a continuation of that to see good things happen in the S&P 500. Here's where I had been talking about VVIX back on May 16th. I was saying we will likely know that we've entered a new volatility regime if we see VVIX close below 100 for 2 consecutive trading days. Has not happened since the pandemic crash. Will also likely spell the capitulation of retail investor segment that came with the pandemic crash. And again, that's speaking to the folks that got that government transfer checks and opened up a brokerage account. And so the chart, goes all the way back to the pandemic. And here's right at 100. We could not get 2 consecutive close until finally. And I think that's because a lot of those retail traders got wiped out. They just gave up. We're into an almost 6-month correction. And no matter how many times you bought the dip, you were not rewarded. And so you're going to get a lot of that retail participation wrung out. And that's healthy. You almost need that to solidify a base in this corrective phase. You need that unhealthy participation out of the market. How else can we now validate, right? Because this was just supposition, right? This was just speculation at the time, back in May 16. You could say I was just speculating. I kind of had I've got good intuition, and I've done this for a long time. So, it was reasonable for me to make this assessment. But here you can see retail. This is also a chart from Goldman Sachs. Retails has sold their U.S. equity purchases from the last 2 years as of May 15th. It's basically what they have. This is their estimated cumulative net retail trader buying of U.S. stocks. And here's where it's come down to. So they've been selling. They've just been getting out. Hence, all that call buying activity has also dried up. That's not good for the market in the near term, and it hasn't been good for the bulk of this year. We don't have those call buyers. But again, you get this cleansing of the market. Remember, most new traders will trade themselves out of the market within 2 years. Well, hello, March 2020 to March 2022. Here we are. This chart right here from JP Morgan talked about CEO confidence, talked about investor sentiment, and here's consumer sentiment, as you can see, down in the dumpster. But, just another way to show future returns when you get, consumer sentiment at these washout levels. Look at the returns 12 months later, 22%, 20%, 1990s mini recession, 30% return when you got consumer sentiment this low. We're all the way down here, folks. I mean, can we go lower? Of course we can, but you want to be a buyer in these ranges. The forward 12-month returns are all significantly positive. Again, we said the consumer's still spending money. We see it in all the Bank of America data. It's out there. Retail sale for the month of May. This is the whole month of May, folks. According to Bank of America credit and debit card spending, it was up 9% year over year. Credit card spending was up 16%. Debit card spending was up 4%. Don't get me wrong, this is a slowdown from April. Remember in April, the card data on a year over year basis grew 11%. So yeah, but you're still talking about extremely elevated numbers here. Retail sales, right? We got a strong retail sales print from the Census Bureau a couple of weeks ago. In real time, every week we get the Johnson Red Book retail sales, and they're still hanging out in the 12s. We had these extreme readings here, probably because of the tax returns. And then we had an extreme or low reading for this cycle, because this is still double digits. I mean, it's still high, but for the cycle, it looks really low, right? I mean, you spend too much, you got to pay down the credit card bill. So you spend a little less. But we're back into the 12s, which is, we've got a lot, most of the numbers this year are in the 12s. 12% plus growth year over year. The high frequency data that we get on a weekly basis. Johnson Red Book retail sales comes out every Tuesday. Again, speaking of Bank of America, right? Credit cards, they're using them more than they're using the debit card, up 16%, right? And in our weekly research report this past weekend, we saw a spike in revolving credit. The way I characterize it is, well, you had a rate of change that dipped into negative territory. And, back here, we were saying the same thing. Look at this quick spike, right? In 2011, look at the spike out of the 2009, 2010, recession into expansion cycle, right? 2009, you're still in negative territory. 2002, the equity market's doing fine, but still consumers take a while to catch up. They take some religion to believe again. And by 2011, it's all good, right? So that's 2 years, 2009 to 2011. Lo and behold, right? 2020, here we are in 2022 with a big spike 2 years later. So a big reason why this looks outsized is simply because of the way, it's positioned on the chart. And you have an extreme dip, you have an extreme rip. It's just rate of change. We talked about the consumer, or I should say the household balance sheet, right? You see in this chart right here, also from Goldman Sachs, the household actual accumulated savings coming into 2022, which was built since 2020. I mean, we got to like $2.5 trillion in the household savings. That's what they've accumulated or accrued over the last 2 years. Obviously, we've never had this level in history, really. So, when we look at the spending data, when we look at the credit card data, we want to know, do we think that they can pay it down? Well, the average household savings says they can. They can. This is the median household saving and checking balances. Again, from Bank of America's internal card data and credit card, as well as checking accounts. And it's, we're well above where we were in 2019. So prior to the pandemic, the checking balances, their checking accounts, still at extremely healthy levels. Again, we're trying to rationalize, is this revolving credit an issue? Again, based on the accumulated savings and checking account balances, no, they should be able to pay it down. We know that the households have been extremely responsible post the financial crisis. Why should we believe them to be anything but that now? And the constant pushback is, yeah, but inflation. Well, we know that. We always have inflation. It's just a matter of what level of inflation we have. Consumers adjust accordingly. At the end of the day, it's still about paying that monthly bill. Doesn't matter the level of inflation. It matters the history that we have so far as the responsibilities of those households. Have those households, whether it's 2% inflation, 3% inflation, or 8% inflation, since 2009, has the household obligations versus their discretionary spending told us they're being irresponsible? No, hasn't. Again, revolving credit, revolving consumer credit. This is just a different version of this chart right here. And we can see it looks like, oh my gosh. But when we index it to 100, we can see we're just back to the levels that we were in 2019, prior to this, massive unwind. Now, if you did your trend line here, we'd probably be, if the recession never happened, if the pandemic never happened, you just continue to draw your trend line, we should be like way up here, but we're not. We're not. It just looks like there's been this tremendous surge and we should be scared about it, but you do a regression trend line and you realize all we are is back to 2019 levels. Stop crying. All right. And speaking of tomorrow's CPI, right? Because folks are still anticipating a decline, even if ever so modest, in CPI. And we got a lot of data that suggests we should be looking for a decline, at least on a year-over-year basis. Three big inputs to global inflation are seen easing from peaks. This is the DRAM, right, your chip stuff, and we've seen those prices come down. This is the shipping index, the Drewry World Shipping Index, and we've seen that come down. This is the fertilizer index, and we've seen that come down over the last few months. We know used car prices have come down dramatically. That's another big component. Really, what we know that is not easing is oil, energy prices, gasoline, so on and so forth. We know that's not. This is the, in terms of supply lines, this is the chart that gets updated every month. This is the New York Fed Global Supply Line Pressure Index. And as you can see, we came down really sharply in April. We had a bump back up in May, but we've come down again. I'm sorry, we had, this was March, then we bumped up in April, and now we're coming back down again in the month of May. And folks, that's before Shanghai reopened or China reopened. What do you think is going to happen, with the New York Fed Global Supply Line Pressure Index, with a full month of China industry reopening? We're probably going to see supply lines ease that much further going forward, which will help overall inflation. S&P Global Hong Kong PMI, boom. And this was after their Omicron issues. Again, you had a surge in PMIs, manufacturing. What do you think is going to happen when China comes back online? We're probably going to get a surge in China manufacturing. And that just helps the overall global economy normalize, if you will. So a lot of data, right? We've gone through a lot of charts, a lot of stuff to kind of negate this constant rhetoric of recession fears and things like that. And I don't want to, completely dismiss the idea of a recession. I just don't see it as imminent. Do we have problems in the economy? Do we have problems in the market? Yes and yes. But right now, there's nothing that defines, nothing that suggests we're going straight into a recession near term. A recession is not imminent. Okay, we have a derating cycle. We know that we're getting all these headlines from retailers. Target recently said, well, we've got to lower our guidance because we have too much supply. And keep in mind, their inventory levels bloated to 42%. Folks, that's not a division, the logistics and buyers divisions of Target that made mistakes. You can't be stupid enough to accidentally bloat your inventories by 42% in a single quarter. It's not possible. The dumbest person would find that impossible to do. Even on purpose, they couldn't do that. The only way you achieve that kind of rapid bloat in inventories is because the stuff that you ordered in the past didn't get there in the quarter it was supposed to. It got delayed, and then all of a sudden, boom, it's all there in one quarter. And you have this massive inventory bloat of goods that are now outdated, right? Think about your seasonal trends from the winter months into spring. So you have all these collections. Think about your linens, your bath stuff, your drapes, your bedding, right? It all has different colors for different seasons. Well, that stuff that was supposed to be sold in the spring, well, it didn't show up here until, this quarter. And now all of a sudden you have to discount it and it's weighing on your inventory, right? Retailers are not in the business of warehousing. They've got to get that through the channel. One way or the other, they have to get it through the channel. So they discount, and that's going to put pressure on Target's margins. I'm of the opinion that's not going to take them very long to clear through that inventory. That's why they took their guidance down. They also said, this is not a matter of the consumer waning. This is not consumption weakness. It's a matter of not having the right goods at the right time, which is not their fault. There's nothing they could have done about the shipping issues. There's nothing that they could have done about supply lines. They're just trying to manage through it. And right now, the best way to manage through it is to discount those goods, to get them out the door, take down your guidance, get to a clean inventory position, and resume your normal market operations, whereby Target has been great, for many, many years. We may get more of these announcements. We don't know. All we need to know as investors is how to manage through it, just like Target's trying to manage through it. Our best way as investors to manage through these times are to endure, to manage that cash on the sidelines wisely. This market moves fast. These economic challenges are very unique. So we need to be flexible and, be nimble when it comes to how we're looking at the back half of this year. Right? I mean, we're almost halfway through June. We've got probably the most widely anticipated and followed economic print coming tomorrow, and a lot will hinge on that. Why? Because the CPI is too hot. There's implications for the Fed monetary policy, and the market is going to try and price that in. Good or bad, the market is going to try and price that in Friday and the subsequent days. So we'll see what that CPI looks like. Be open-minded, flexible, and thank you again, as always, for joining us here on our weekly State of the Market. Have a good one, folks.